Hi, I'm Adam Darcy, CPO at Trustly. I think the main thing is the data it comes with. So when a consumer transacts with their bank account, we get a window into their recent kind of financial history into their bank, which you don't get with any type of card. A card is just an access method to the account, be it a credit card or a debit card. There's an underlying account there, but you don't get access to that during the point of a transaction, and that's the really exciting thing, which unlocks a lot of different use cases, which the market's very excited about. The other beauty of the pay by bank model as well, you actually cut out a bunch of parties in the value chain. So you can actually bring the cost down significantly for the merchant as well, which is always something they're very keen to discuss, because payments costs can be quite a high cost item for very high volume, low margin merchants. Think about grocers as just one example. Another differentiator with Pay by Bank is we actually guarantee the transaction for a lot of our clients, which means they don't have to think about chargebacks. We take care of that. And again, how do we do that? Because we actually see into the bank account. There's a lot of behavior that we get to see from the consumer. And also we have a network effect as well. The more consumers use our product, the more we can see different types of fraudulent behaviors across the network, and we use that to bring our losses down and then our costs down as well. We're the first users of our data product because we get all of that bank account data. We built models, and because we gave that guarantee to the market, it was in our best interest to bring down the loss rates as much as we could. And like any product like this, you learn a lot in the beginning, and then you have to be careful with you've got to get approval rates up as well to be comparative to debit cards. That's always the benchmark, but then you've got to get your losses as well. So it's a constant balance, and the market's obviously very dynamic. Fraudsters are very smart. When you block one thing, they'll find another way in. But yeah, we've used that data over the years to build very smart models, such as, we have an NSF model which predicts the likelihood of an NSF on this transaction to this consumer based on the banking history and based on what we know about them as well. So there's a ton of different things that go into that model. And then the result, it gives us a decision on whether we want to let that transaction through. So yeah, we've had a lot of learnings over the years and offering that to the market. And now that demonstrates to the market that you can actually take this data as well and do something customized to your industry, or we can help you and do it on your behalf, of course. I think it's always a value exchange, and you have adoption curves as well in any market. The model crossing the chasm. There's the final kind of penetration is the laggards, who sometimes you can never get them to adopt, but that's fine. The market, there's 80% of the market, and before you get to them, who'd be willing to adopt new technology. But you need to have a value exchange, right? What new value are you providing to me that I'm not getting today with my cards or whatever payment instruments I use, including cash and check? And then the merchants are offering that value to their consumers, using the functionality that we provide. So if you take some of the big telcos as an example, they're actually offering discounts to push people onto Pay by Bank because it's just so much cheaper than, say, a credit card transaction where you're paying a few percent on quite a high bill every month. That really eats into their profits. So a lot of the incentives are actually given to the consumer by the merchants themselves. And we see a lot of adoption, but we're saving hundreds of millions of payment costs for merchants because consumers are willing to switch. It's as easy as logging into your bank on your mobile phone. People do it every day. I used to work in the first wave of mobile banking when the iPhone first came out, and one of the huge learnings we had, and everyone was surprised about it, was that people go into their bank less than once a month on average. And then when they had internet banking where you're typing with 2 fingers, username, password, and having these codes, it was about 5 times a month they were seeing their customer. And when we launched the first kind of Touch ID before Face ID, and we saw customers come in 40 times a month, so more than once a day. So it's incredible just how much engagement you can get when you reduce the friction for your customers. So I think there's a huge learning there that people do want to engage with their money there. But if you take away those barriers of friction, you can get surprisingly high results. I think for Pay by Bank, we are as good as their mobile banking app. So if you're with Chase or Citi, whatever the experiences they provide, we hand off to their experience, right? Because we really want, the banks have a lot of security in there. We want customers to feel, they're using their bank to give permission to us to be able to do the transaction on the merchant's behalf. It's really important that we provide a frictionless experience, but most of it is owned by the bank. So again, there's lots of different ways to bring that friction down for consumers and provide value there, just having a really smooth checkout along with any other value you get from the data I mentioned earlier. I think in order to gain consumer adoption, in the US it's very carded. We've got very high interchange, which means customers get tons of value every time they swipe their card. So it's the only payment instrument they ever want to use if they can. If they can't use it, they actually get angry sometimes, and the merchants are kind of forced to implement credit. So that's what we're up against. We're up against, a model where the merchants are paying very high fees, and a lot of that is being passed back to consumers. I think in the US, it's about 1.65% on average that consumers are getting. What we know about that, if you look at, never take an average, right? When you break down an average, 1.6x%, that's not every US consumer getting that. I think only about 40% of people pay off their bill each month. A lot of people just have that, hang over to the next month, and then a lot of people get into persistent debt. This is there's a lot of CFPB work being done on analyzing this. So I think there's a lot of consumers who aren't getting value from the credit card, but they're using it as a credit device because that's the only thing they have today. You've got emerging credit products like Buy Now, Pay Later as well. I think they're very interesting. You see a lot of adoption, particularly from young people who just want more control. They don't want a credit account. They want credit at the transaction level, which is really great. But that has issues with that model as well, such as stacking, and there's no reporting to the bureaus, so you can overconsume. So there's risk there as well on the credit side. I think what Trustly is seeing when we talk to the big retailers like the grocers, Petrol and QSR and these, they understand that getting that segment of consumers who get value from the card, getting them to shift to something else is going to be very difficult. However, there's a whole kind of latent segment of customers that aren't getting as much value. They're using it as a credit device, and not a very good one. It's been around for decades, and they're looking for something better. We believe Pay by Bank actually, because of the savings that Pay by Bank provides, you can give back some of that saving to the customer and still be way below credit in terms of payment costs. But at the same time, you actually get increased AOV because the consumer is actually getting more value in terms of, loyalty points is one thing you can do. You could provide, different types of credit or installment payments. So there's a lot of different permutations of products you could offer to different types of customers in different industries. And again, this is all unlocked by the data that comes with Pay by Bank in order to enable this. So moving customers from debit to something else is difficult. If they've chosen debit as an instrument, it's either usually because credit isn't accepted, or they don't want to use credit because they don't want to carry that particular transaction over to the next month. So things like, your bills and things, you really don't want to be pushing those to the next month, because guess what? You've got another one coming next month. So you don't want to start to see those pile up and compound with interest. So people are using debit for a reason, but you can provide more value on debit, because debit is a dumb device. It's literally it's a number that links to a bank account, and your acquirer as a merchant will say yes or no. And maybe you'll get the BIN number to see which bank it was, or the card type at best. But that's post-analysis. If you do Pay by Bank and suddenly you've got this stream of transaction data coming at you at the point of transaction with the consumer, like I mentioned earlier, there's a ton of value there. Do you have to pay for it all now? Looking in your account, we can actually spread this across time. And by the way, we don't want to go into next month, but we could spread it across your pay cycles. We're seeing a lot of evidence in the US, 50% people get paid bi-weekly, another quarter weekly. So it's not like people are all getting paid monthly. A lot of the bills are monthly. We see a lot of friction there with the debit instrument. It doesn't provide value in terms of conserving your cash across your pay cycles. Bills come when they come, and people have to pay them when they pay them.